Well, first and foremost, thank you very much for inviting me here to the CEE Summit. It's a pleasure. It's also quite a challenge to follow after fantastic presentations and discussions this morning. So I'll try to kind of enhance and provide some further insight on the topics. The theme of turning points and challenges continues. The ESG challenge in transition in industry is the topic of my 10 minutes talk. And I think let's start simply. If over the last 15 years or so, INREV, as a European organization for investors in non-listed real estate, has been asking investors what are the key reasons for investing in our asset class. We like our consistency. You know, the diversification and multi-asset portfolio has been an answer for a very long time. And then, recently, we have started asking questions about to what extent the ESG considerations are taken into account when making allocations to non-listed real estate funds. This is a global result. 68% of investors globally, according to 2022 survey, think net zero carbon commitment is already embedded in their decision making. 87% when it comes to environmentally socially responsible investments, and 66% when it comes to diversity, equity, and inclusion programs. Well, that's fantastic. It's a great start. There's some differences across the board. We have Zoe on the line, so that's fantastic because Australia is really powering ahead in terms of where they are on the ESG journey, and it is a journey. Europe is somewhere in ahead on the environmental side of things, but perhaps a little bit more behind on the diversity, equity, inclusion. But the trouble is, there is very little standard in the market when it comes to reporting, due diligence, assessment, and key questions when it comes to the ESG. And yet, it is critical to ask going forward. This is where INREV comes in. So we are working tirelessly, and as part of our strategic agenda, to create an alignment and to create well-established ESG framework for all of you investors and fund managers and participants in the non-listed real estate market. When it comes to sustainability reporting guidelines, due diligence questionnaires, governance, our discussions with regulators when it comes to SFDR, when you have to run before the train and report, when it's already required for periodic reporting, but it's not yet finalized in terms of guidelines. We're also doing a lot on the data front, and I'll spend some time today showing some of the data so you can see what it really looks like, but also, of course, impact investing and net zero carbon. So I'm here to reach out to our friends and neighbors in CE just to raise awareness that that educational piece and discussion is taking place in INREV, at INREV with the industry. Join in, participate. We can do better together. So what is ESG? Well, it's a complex, multifaceted dilemma and a question. On environmental, that's where most of the focus has been to date, because as an industry, that's where we can make lots of change. You know, energy consumption, green gases emissions, water consumption, waste management, certification, so on. On the social side of things, it's moving along, but it's a bit more difficult to assess because different firms do it differently. There is no standard in place, and as I've mentioned already, particularly on diversity, equity, and inclusion, Europe is actually lagging behind, even the US, because also some regulated, like in terms of privacy, stops us in Europe from asking the questions which are so important on the topic. And then suddenly, a few months ago, as the war in Ukraine broke down, the governance piece have just swiftly moved off the top of the agenda as well, because when it comes to accountability and transparency, whom are you renting to, whom are you doing business with, has become really, really important to assess here and now and have that visibility. So quite a few challenges there. I have 8 minutes left, so I'll be very honest in saying I will only pick a few aspects of this discussion just to give it a little bit of flavor before we go in and talk in a bit more detail during the panel. And I will focus on what is priority and a little bit of complexity. Energy, carbon, data, and that will be the key topic of discussion. But as you can see, according to this illustration, there are many complexities within the ESG debate that it will take us weeks to keep discussing, and it will be far from reaching any kind of meaningful consensus. So this is a journey that we are beginning as an industry. We like data. Data gives us knowledge. Data gives us power and understanding where we are, be it with our individual portfolio or in the marketplace. Unfortunately, when it comes to the ESG, at the individual case study basis, like Damien was showing, or within your organization, you might be already starting to see some visibility in terms of data. But at the industry level, the data is still quite limited. And this is where INREV are really making sure that our duty of care to you as an industry is supporting you with the data. A few months ago, we have started a pilot project which extends our long-term work on the asset level index, which talks about performance at the asset level in Europe, and has a coverage of about 200 billion gross asset value and more than 6,000 assets, and extended them now to include sustainability KPIs, with the idea that over time we can build a very special data set that allows you to really understand what does your asset look like in the context of that specific segment of the market. What does your portfolio look like compared to your peers? And what does it mean on that journey of ESG that we are all working along? So this is an example of what if we were to use the current energy use as of 2020 reporting and the carbon intensity use of 2020 reporting on the sample that we've got, which is roughly about 35 billion, but it breaks down into 22 and 24 billion worth of assets, and where, at which point in time, the accumulated assets become stranded. This is the picture. It's bleak. Less than 10 years' time, a third of the assets in Europe, based on this sample, will be stranded. Come 2050, more than 50% on the basis of energy use and more, around 50% on the carbon intensity use will be stranded. Now, this is pilot. What happens with pilot projects, you get the better quality data first. So actually, the reality is that picture is even more bleak and when we get more information, INREV will ensure that we're informing you so you can really understand what journey we have ahead of us. So yes, it's important. Net carbon initiative and the conversation of EU is really, really important because we have clear deadline by 2050. We know that 40% of the EU total energy consumption is with the buildings. We know that 36% of EU greenhouse gas sits within our industry. And we also know that in several cities in Europe, that's bigger the problem than in others. All of that combined sets many challenges. I'm lucky. In the Netherlands, who are also, when it comes to Europe, are quite ahead in their ESG agenda, particularly driven by large institutional investors. So the data that we've collected in our pilot project is already very robust when it comes to the Dutch market. It covers about 12 billion worth of assets in terms of gross asset value. It covers more than 1,100 assets by number. And so I decided to share this information with you, not only at the overall market level, but actually in Netherlands by sector. This is what it looks like when it comes to energy use intensity. You've got the light blue, which is the 2022 pathway. you've got the green, bright green, which is 2030 pathway, and the dark green, which is 2050 pathway. Look carefully. Few things stand out. When it comes to the 2022 target to be not stranded, only on average, only high street retail shop and the average office in the Netherlands is still within that pathway not being stranded. Beyond that, across all of the segments of the market in the Netherlands, which is already ahead of the curve in terms of ESG initiative, very supercharged by local investors, we are already on average in the stranded territory. And how scary does the 2050 picture looks from here? Also, in absolute level, if you compare one sector to another, the shopping centers, you know, until 3 years ago, you know, still quite a well-performing asset class is also penalized on this level because it's very high in terms of energy use intensity, and that will also work against it in the portfolio allocations. Similar picture is on the carbon intensity tool, maybe a little bit better in the short term and until 2030 for, again, high street retail and the offices. But the picture is equally bleak. Our end of the journey is in 2050 or before, and you can see where the average for the Netherlands stands, assuming we do nothing today. The good news, on average, for the office in the Netherlands, the assets will become stranded in the year 2038. Now, that gives us plenty of time to put things into action, and the action is timely, and the action is now. One of the biggest takeaways that I took from our autumn conference, which was in Copenhagen in November 2021, which was completely ESG a dedicated conference, and from the event in Athens, which is our annual conference last week, is ESG has really taken off as a topic beyond disclosure. It's now on the mind of every investor and the fund manager in terms of action and actually embedding the strategy into making sure we are moving on that ESG journey. The other point I wanted to highlight is not all markets are the same. So I can't give you, based on the data that I have today, because I needed a bit more time to collect it, where the average stranded position is for offices in Europe. I know it is 2038 for the Netherlands, but what I can show you is the relativity of the pathways. So the direction of travel is clear. The end of the journey when it comes to net zero 2050 is the same, but the starting point is very different. Two things that stand out here to me first and foremost is when it comes to France, because of the nuclear power, they are very well positioned in terms of current position in the market and the pathway itself. When it comes to the CE markets, and particularly Czech Republic and Poland, the energy use intensity is very high, and the carbon emissions of the back to generate that energy use is also very high. So you are starting at the very top and higher than average in terms of office markets in Europe. There are a few things in that. There is a struggle, because of course it will be a challenge to still get to that very low point that everybody else is going to by the time it's 2050 and being carbon neutral. But equally, maybe there is an opportunity for a purpose and repositioning and retrofitting, which some investors might be open to taking up, and that's really a fantastic opportunity if you can do that. Equally, not all buildings are average. So perhaps arguably, if you have ESG compliant building today, or a building which is moving towards that stronger ESG compliance today, you maybe benefit from certain rental premium occupancy rates, and once we figure out what that number is, green premium overall. So I would like to leave you with a food for thought before we open the discussion and highlight that INREV engagement with the industry is to emphasize the importance of ESG goals when it comes to performance, both at the asset and the fund level. At the asset level, we're trying to carry over the sustainability pilot project to the US. We're working very closely with NACRIF, who already have financial asset level reporting as we do here in Europe. It's consistent. We work together as partners. And we want to encourage the US fund managers and investors to borrow our KPIs for sustainability and use that in their market. We would like to build up the market industry level information so you can utilize back and see how does your asset look like in that segment of the market. How does your portfolio look like compared to your peers? So that's a journey for us as well. But that journey can only happen with you on board. So please engage. And of course, best practices, governance, and common standards. So when investors are looking at the set of questions, when they are making a choice between one fund or the other, they are looking at something which is more apples for apples, rather than parent or orange and a little bit of lime. Thank you very much.
Great, thank you very much, Irina. Okay, so we come to our first panel discussion, and if we can actually have the slide with the panelists, that would be great. So I'd like to invite up onto stage, so Irina, if you can come back up and take a seat, Christopher Zoyner, who is the member of the board and chief investment officer for 7R. Marcin Juszczyk, who is board member, CIO and CFO for Capital Park. Maybe at the end we'll do one large round of applause. Just. We have Zoe up in the top right-hand corner for us there. Zoe is sector lead from Neighbours, which is a national Australian-built environmental rating system. Damien Harrington, who we met earlier. Damien is the head of EMEA research for Colliers. And Joanna Pleasant, who is a strategic partnership and sustainability associate director for Arcadis. So just a nice warm welcome for our panel. And if you could just say a few words, starting with you, Chris, your role and what 7R does.
Hi, my name is Chris Zoyner. I work with 7R. We're a logistics developer in Poland, about 200 employees and about 20% market share. And we're looking to grow into other European countries.
Thank you, Chris. My name is Irina Polubchuk. I am Director of Research and Market Information at INREV, who are driving transparency, standards, and better informed decision-making for investors and fund managers in Europe.
Good morning. My name is Marcin Juszczyk. I am board member responsible for investment and finance areas in Capital Park Group. Capital Park is a listed company, investment management and development company acting on a Polish real estate market since 2003. We have about 100 employees and we develop commercial buildings, mixed-use buildings, and now moving towards residential more and more.
Joanna?
Hi, hello. Good morning. My name is Joanna Plezon. I'm a strategic partnership and sustainability associate director at Arcadis Poland, and also part of the big project ESG Pan-European Group. Arcadis is a design, engineering and construction consultancy company for built and natural asset. So with our three lines, resilience, mobility and places, and the sustainability as a hat on all over three lines, we support clients in implementing the sustainability solutions in all kinds of projects, from roads to buildings.
Damien Harrington, Head of Research for EMIF at Colliers, working with occupier services, capital markets and property management platforms, and also, because I don't have enough to do, I work with our global capital markets platform as Head of Research for them.
Thank you. And Zoe?
Good morning, everyone. My name is Zoe Baker. I'm a sector lead at Neighbours, which means that I'm in the sort of customer and market development part of the program. We're a government program, so Neighbours really does what it says on the box. It is Australia's benchmarking tool for the property industry. for building performance, and that's across energy, water, waste, indoor environment, and we've got a carbon neutral pathway for buildings as well.
Okay, great. Well, Zoe, thank you very much for joining us. Have you been to Poland before, by the way?
I haven't, but it's on my list.
Okay, well, you're very welcome. You have some friends here already. I just want to ask you, because I first came across Neighbours from the Collier's report, you were held up as a standard bearer for an effective ratings measurement agency. And can you just say a little bit like why you were set up, who set you up, and what was the specific purpose for you to be set up?
Yeah, so the program's quite old in terms of government programs. We've been around since 1998, so going on 24 years this year. And we are a government program, so the program was started as a collaboration between the New South Wales government, which is one of the states in Australia, and the federal government. And the purpose was really to be that agnostic tool through which you can measure the real performance of a building, of an asset. So we started out in the commercial office sector, so measuring bigger office buildings. That sector now has mandatory disclosure, which has been part of the kind of that trajectory of government stepping into that space to try and assist the commercial property industry to improve. But
Sorry, Zoe, can I jump in a second? So it's mandatory. For how long has it been mandatory for... These are building owners to declare certain elements of their project. Is that right?
Yes, this is the exciting thing that everyone looks to Australia to say, wow, that's something that other countries would like to see. So it's mandatory only for your bigger commercial office buildings, and that's been around since the early 2000s. I think 2004 or 5 that disclosure legislation came in. And it's really at the point of lease or sale, and so for your bigger commercial buildings, they're getting a Neighbours rating every year because they've always got flux in tenants. And the beauty of that is that it sort of drives then the market to, one, have something to benchmark buildings against each other, but it also creates this market demand. And that's demonstrated, but that is also the design of that investors and potential tenants can make a decision about which building performs better.
Okay.
That's going to help them out, even if that rating is mandatory for the base building, so for the common parts of the building, not necessarily for the individual tenancies. But it does tell you something about how the overall building is running, and you can use that benchmark to demonstrate the improvements that have been made in the building in a very agnostic way. It's not talking about specific elements that you've done to upgrade the building, but just purely this is the real performance of the building, taking into consideration your consumption data, but also a lot of attributes about the building. So it's to that apples for apples comparison requirement. When you get a Neighbours rating and it's a star rating, so it's stars out of 6 stars. If you have a 5-star building, that means that building is 5-star compared to other buildings like it, the similar kind of size, the similar sort of attributes, and in a similar climate as well.
So it's a shifting. Yeah, it's a shifting. I think so. The rating is related to others, to peers. Yeah.
Absolutely.
And this is only for office. Yeah, this is only for office, not for retail and warehouse.
So we started out just as an office tool, but we've been around 24 years. We're not sitting on our thumbs here, so we have expanded in that time, and we have a rating for the tenancies within office. We have a shopping centre tool. We've got a hotel tool. We've got the most recent one we launched last year was our retirement living and residential aged care tools. We have a hospitals tool where data centres. So we do have some spaces that we don't have a tool for yet, although we're working on that total building domination. We're currently working on that warehouse and cold store sector, and there's massive opportunity for improvement in that sector. We're also looking at retail, so we've got shopping centre, but for those individual retailers and other kinds of retail businesses. And we've got a trajectory to move into, we've got a schools tool that we'll develop in the next
Wow, so you're really leading in lots of different... Sorry, I'm going to appear really rude for interrupting you, because, but I do want to make it a bit of a conversation as well, and you're leading the way, so we have you here for an hour, and I want to just... Damien, in terms of... because you mentioned it in your report that they were leading the way, are other countries, other regions also doing this sort of thing, or not?
I mean, I think it's down to this standard that's been set in the way that they measure buildings. So the critical thing that's come through from working with our property management team and the favourability towards neighbours is it's been measuring energy use consistently for a long time. Lots of other standards haven't, or not really focusing on it specifically. So that's why it's growing so quickly in the UK. So if you talk to a lot of construction managers now who are building new projects, they're already integrating it in, because the energy use in a building has become absolutely critical. And that's why everybody in the UK knows everybody needs good neighbours, right? That's my pun for the day, but there you go. So you only get one, thank God.
Okay. Joanna, how about from you? Because you talk to a lot of construction companies, you're in talking with them. I mean, are you seeing a drive towards mandatory or declaration of certain standards and elements? And also, I mean, are people open to this? Do they want to see? Do they want to be part of this, or are they resisting attempts to get to declare certain elements of their buildings?
I will try to be short. It's a deep topic. So first of all, let me tell you how the transactional market changed within the last year and a half. I'm leading a team of sustainability engineers, and normally as Arcadis we always start with TDD process, technical and environmental due diligence process on transaction. From like 7 months, I've noticed that the first thing that the investors are checking are the sustainability part. So what they are asking us for is, of course, certification, but I really would like to stress out that ESG is much more than BREEAM and WELL certification. It's just a little promille of everything that is important. And I give you an example. Lately we were doing a BREEAM pre-assessment for a couple of logistic assets and net zero pathway for those assets, and with CapEx. So the amount of investment was about 100,000 euro for BREEAM against 10 million euros for net zero pathway. So this is what investors are looking for. So net zero is a very important topic. And we see a difference. We see a very big push from the investor side. So there are a lot of clients that are not waiting for the governmental guidance because they see the push from clients from each and every corner. So we see bigger and bigger number of PRI signatures. And those investors are really having very deep sustainability strategy, and their investment needs to meet this strategy. So if we are checking carbon due diligence on building, we already see once and result from carbon due diligence being a deal breaker. And it was the first time last year when we were really, okay, this is coming. This is
deal breaker in terms of what? Investment?
Transaction.
Or in a transaction?
Transaction. Okay. Because if you have investors...
So what was wrong with the...
It was too much of carbon emissions for the operational carbon.
In which sector?
It was an office. Okay. So, and then when the investors are coming and asking us for checking how to get rid of fossil fuels, then we have a problem. Then the Polish market has a real issue, because even if we advise some of the solutions, it's still connected in a way with the fossil fuels. Yeah. So there is a lot of work to do around all those topics. Also, if you look at the general contractors, we have been meeting with ideas, with requests of general contractors having maybe not the full ESG reports, but they are investors interested in ESG ratings. So some of the general contractors are coming to us, okay, what is EcoVadis? How can I get it? How can I implement it? And it's not something that you can do over a week. So
it's still the early days. I mean, as we're talking, this is such a huge topic and we can only just dip into it in this hour. But Chris, I want to go, because you are, let's say, a regular developer, and I'm just wondering, what is your ESG story or ESG attitude? How do you see ESG?
I think the focus always ends up being on the E out of the SG, and I'll focus on that mainly. But it's a challenge. You know, we're not a huge business or multinational. Some of our competitors do extremely good jobs at sharing information of the challenges that we have within our sector.
And they share information?
Yes.
Really?
And I think, look, my background is not in logistics. It's sort of multi-assets. And one of the things that I've been really impressed with the logistics sector is how competitors in some areas or in a normal line of business are very open to sharing best practices on things that they've actually expanded. And, you know, GLP and Prologis are two who I really commend for that. So it is a challenge for us given our size. Technology is changing continually, and it takes a lot of resource and specific knowledge to try and address. I still, even though I'm a big believer in free market, I think I would hazard a guess 98% or more of the people in this room believe in progressive ESG approaches, but until there is a mandatory, and by which I mean government or legislative-led doctrine for all developers, real estate players, etc., to follow, or to justify why they're not following a particular best practice. We can all sit in this room and we can say we want to do X, Y, Z, follow all kinds of different ways of getting different certifications, but it's very, very difficult to do if there isn't a singular set of rules to follow for everybody, so we're all on a level playing field, as there is, for example, with accounting. You have GAAP. There needs to be something which can be recognized in a far broader base than just Poland to actually achieve something that's meaningful and long-term.
And are you getting pushed from above and below, let's say above from investors and below from tenants, or are you self-motivated in this sense?
I think it varies. A lot of it is self-motivation. We're a private business, and as a team, we genuinely believe in improvement there. Some tenants push more than others. Some are more focused on costs within our sector. Some tenants also, frankly, want a box that's ticked and there's not really much behind it. I think there is more of a lead between tenants and investors from the investor side, but that's also, given the nature of the business and the fact that a lot of them are investing third-party money rather than their own balance sheet, then there's that pressure that comes from people who are further away from the process and don't necessarily have an understanding of it.
Okay. Martin, Capital Park has just published a report, is that correct? Can you just say a little bit about this report? What drove it and what the main results, findings from it were?
Of course. So that was not obligatory for us, but we decided to do this as ESG was always at the forefront of our all efforts, especially E. We started as a private company, and back in, let's say, so there's one example I want to tell you, and this refers to a green premium that you mentioned in your part. So we're back in 2006. We bought Eurocentrum office complex from a Turkish developer. And we started the redesign process. So we hired architects, but we also checked with the agents with the tenant reps and agents on commercial real estate market, whether it makes sense to actually certify the building or invest in the green technologies. And they said, "Oh, look, no one's going to pay for this." But we insisted on this. And we certified at the design stage. At that stage, we received LEED Gold certification for Eurocentrum office complex. We finished the building in 3 phases in 2015. And basically, after completion, it was certified LEED Platinum. And it was one of the first buildings certified LEED Platinum at that stage in Poland. Definitely the biggest building that was certified LEED Platinum, so the highest standard. Really energy efficient. And then fast forward to 2019, when the building was sold, we first developed this to hold, but then our strategy changed, so we put it on sale, 100% leased. And the buyer that actually bought this building paid us a 20% premium over the book value, which was already marked to market in our financial statements, because they were able to then issue green bonds to finance their whole acquisition program on the back of this, among others, on the back of this building. So is it worth? Yes, of course it's worth it. Then in 2013 we became public company, so G started to play a big role We've always
What was G talked about in this sort of setting, ESG, back in 2013? Or?
It was the same because it's about governance in a public company and following also the best practices of the corporate governance that are issued by the stock exchange. So there's a rule that you have to publish, either you comply or you explain why not. So of course we followed these rules. Of course we set up a management board and the proper structure of the supervisory board with 2 independent board members and one. There are certain rules. There's audit committee, which majority has to be independent board members, etc. So I won't go into the details of that, but we were basically happy to implement those rules because we thought that will enable us to access the capital markets and get the capital needed for our growth. And then there are these best practices that we follow. We follow about 70% of the rules, and we publish why we don't follow the rest. Some of them just are not for our business. They are not relevant. Some of them we don't comply because we think it's a little bit maybe too costly to do that. For taking into account our stakeholders' needs also. And this year, yes, we decided to start with the ESG report, and we published first sustainability report for 2021, and we used SASB methodology because we thought that's something that our investors, especially our majority investor from the US, is also used to follow, and it was a great journey because we first sent a questionnaire to all our stakeholders, asking them what are their priorities, what information needs they have, and they want to see in our report. And based
So when
on
you
this,
say stakeholders, you mean owners, investors, or also
shareholders, employees, banks, debt capital
Tenants.
markets, investors, tenants, yes, all various groups of parties that are interested in our business. And so it's not only shareholders.
And can I, in one nutshell, what was the main finding of this report?
Based on this report, we were able to actually structure our final. Based on this questionnaire, we were able to structure our final report. So we needed what to report and what is less important. So of course, environmental issues were very important, but also energy consumption, so heat consumption, water consumption, electricity consumption, but also we use TCFD framework to report on greenhouse emission levels, and we also put in a structured way this information and for our investors to be able to compare it with different peers. So that was an important step. We always had a lot of initiatives also under S, but we thought this way of reporting will enable us to actually show it to the wider public in a more structured way.
Okay, and this report is available, yeah.
This report is available in Polish and English on our website.
Great. Zoe, I want to ask you, what are the main, because you work also with tenants and building owners, etc., what are the main challenges and priorities, again, in a nutshell? I know it's a huge topic, but that your stakeholders are telling you that is concerning them, challenging for them, opportunity?
Yeah, I mean, I think that as multiple of my fellow panelists have said, the E has been the focus, and that is what NABERS does. So that's the maturity of the market. The corporations and companies and building owners have started to move to a much more, that much bigger scope. And so obviously NABERS can talk about the environmental impact of your building, but they're looking at that beyond the building performance through to scope 3, much more mature approach to things like waste, which we're trying to meet them there. But there's a lot of concerns that don't kind of fit within the NABERS framework, that those are not things that we're placed to measure. And I think if that's great, I think that's where we need to be, is that companies are looking at that triple bottom line and looking at a much broader scope of impact. and we're there to do the part that we can do. So that's definitely the challenge from the customer side. From our side, one of the big challenges is that, as has been mentioned with voluntary programs, and although we've got some mandatory disclosure for your bigger commercial office, there's big parts of the building sector and sectors that we aren't reaching, and we know that kind of pulling them along the way is a big challenge for us, and that's something that we need to work out how to do, because we're facing a big problem, and we don't want to leave people behind. We don't want to have those stranded assets in our cities.
Okay. And what are no, sorry, I think we'll leave that one for the moment. I'll pass over to Richard, because this is maybe a bigger topic for later. Richard, a few questions?
Yeah, sure. Thanks very much. Also, if anybody's got any questions that they want to ask or any views that they want to share, it'd be interesting. You know, particularly I know that you're here, Hubert. You know, there's some interesting topics around what may be happening in your jurisdiction, for example. But I wanted just to pick up a little bit on the sort of social impact side of things. That's obviously been a hugely growing topic, particularly if I look at it in the UK, but also what we've seen from the US. Maybe, Damien, just starting with you. I mean, how much of a topic is that for the capital markets side? How much is that becoming a more important aspect?
Well, as I tried to point out earlier, there are two aspects to it. There's the social part of the employee in the building and how that's becoming more important. I mean, our property management team have got this kind of thing called the Hive, so they look at all of the different elements that drive ESG, and the social part is becoming a bigger part of it. So we'll embed things like Fitwell into the Hive to help assess assets, and even working with the occupiers, it's becoming more prevalent in terms of them wanting to push this forward in the agenda. So that is definitely growing on that side, but the impact investment part, you know, affordable housing, living, that is definitely growing in scope significantly. I'd say Arena's probably got a better idea than me in terms of funds registered, looking at that specifically, but anecdotally, we know it's growing quite a bit. It's quite a challenge, but I think, well, Sabina, I think you've got your own affordable housing fund for Europe, right? So,
I mean, it would be interesting actually to pick that point up, Arena, just because certainly from the discussions I've been having recently with the investor relations side and people who are raising capital, it's increasingly difficult to look at ones that aren't either Article 8 or now potentially Article 9. So is that a big change, Arena? Is that something that you're obviously seeing that from INREV, I would imagine?
Yeah, I was thinking, should I open that can of worms or not? But you did it for me. So I think there's lots of things around SFDR in the sense that, you know, it is in the making. We have a lot of pressure from the investors, but it's not going to be finalized until sometime next year. Now, it's also misunderstood, unfortunately, because the Article 6, 8, and 9 are not designed to be fund labels. They're designed to be disclosure pathways. But our industry, and at no fault of our own, that's how it's being interpreted. And I think that there is a real danger in that, and it needs to be quite a big educational piece to explain that those are not fund labels. Those are disclosure regimes. When it comes to Article 8, it's all about disclosure. And that brings consistency, that brings more data, more information. When it comes to Article 9, it's all about do not do significant harm, and then have a very incorporated ESG strategy around that. So I think that's one component. And then talking about Article 8, 9 funds, well, it's not a label. We should be very careful. At the end of the day, as we continue on this journey, I think most of the funds within the EU, or let's say mature markets, should be reporting under Article 8 or 9. There will be very few below that. But I think that's something that we as an industry need to understand. And there is another component that perhaps we will talk at a later stage, but it's about how does ESG strategy, not only the green building today, but the transitioning path is embedded into valuations and value. And I think that's a big challenge because, valuations are backward-looking. The mechanism is not designed to, incorporate something that is moving and evolving as we speak. There's very little comparable evidence. I think we should have more data coming from you and the like. But until that sorted, will be a while before we really know what that spend on the ESG today mean in terms of value and worth as that transition is taking place.
And it'd be interesting just to pick up with you, Christopher. I mean, how much investment are you making in these sort of the kind of social impact side? How much of this is being driven, I suppose, by investors, by occupiers? How much by regulation? How do you see that balance? Because you're obviously looking at the investment side and the numbers.
Sure. Without a doubt, the focus of the ES is being driven by tenants. From us, it improves the liquidity and the leasability of what we're actually producing, and that's something we work very hard on. It's a generalization, but I would say there's definitely less focus on the S side from investors by comparison. They want to know they've got a sticky tenant, but and one can help that argument with it, but it's not about having a specific focus on the social side of what we produce.
Okay, good. And is one of the areas of, I mean, it might be interesting to get your perspective on this, Zoe, is one of the areas that it's, whereas the E is much more easier, I suppose, in terms of being able to check what it is and do all of this. Is it more difficult for social impact? And how does that work in Australia in terms of people being able to assess it?
Yeah, I mean, you can't go and read a meter for social impact as you can for energy. So it is really tricky. There are a few standards that different industries work, and I think someone else has already mentioned that those things are being measured in different sectors and by different people in different ways. So I don't want to call it an inconsistency, but lack of consistency and lack of a sort of single way to report that stuff just makes it really hard. And I think there's lots of will, and there's a real desire in lots of different sectors, but particularly in the property sector, to build right and build for equity and that kind of thing. But that's really tricky to measure and be able to actually say what it is. And yeah, tricky.
Yeah, I mean,
we haven't found a way to have a social impact rating under NABERS yet, but we'll let you know if we're starting to work on it.
No, it's one of the interesting things. I mean, we launched a thing called Impact last year, and one of the aims of that is actually to be able to bring people together to talk about some of those challenges and actually to see how that can evolve, because it is a really interesting area. I think you'd got a question.
Thank you. A question to Chris and Marcin. Do you rank your potential tenants on their own ESG criteria and measure them as in accordance with how important they are for you as a tenant, rather than just the building that you're supplying for them?
Do we rank them? Probably not. Do we take it into account when we're looking, if we've got two tenants looking at a project which we have, then yes, but I think it's not something that we do on an empiric basis. But certainly we realise it drives value. DHL has a very clear ESG approach of what they require from buildings, and we know that investors will like that when we come to an exit, whereas a tenant which is more on the production side, which maybe isn't there, then we're aware that can impact what our exit value is going to be.
Okay, good. Sabina, it might be interesting. Are you at CBRE Investment Managers, are you beginning to have to look at the types of tenants that you've got because of the drive from certainly some of the capital?
I mean, we're trying to do it everywhere globally because it's the right thing to do, and because financially it does impact the valuation and the metrics around your own ESG credentials. In terms of the capital sources driving us towards ESG, that's very much concentrated in Europe. And in fact, what's fascinating to me is when we talk to some capital sources in the US and elsewhere in the world, they're not yet there on seeing why they need to do this and whether it has an impact on their financial returns. So we do deal with a very heterogeneous group of individuals at the capital source level on this. In terms of dealing with tenants, we're much more aware of what they're doing, but it's about partnership, right? So with some, if they're doing sort of hardcore production, it's not going to get there. But there are ways of taking that conversation forward. I think with all of these things, whether it's the building or the tenant, we're not just out there to buy shiny, rated A buildings. We want to improve. We want to be part of that improvement conversation.
It'd be interesting just to pick up from you, Joanna, as well. I mean, obviously, CE region in general, obviously it has a lot of bright new shiny buildings, but that's because they weren't there before. So it's not that something's been demolished and rebuilt. So I suppose, how important is that for the region, and different actually to, let's say the UK or France or Germany? And I guess, how much of a drive is there now? I mean, we're sitting in a fantastic building that is based on an old factory. So how much of that's sort of that transition side, rather than knocking down and rebuilding? Do you think that's going to be a growing trend here across the region?
Okay. If you let me out just one sentence on the social aspect,
yes.
Why it's important, and probably some of you are aware, we're talking about environmental measures. It's easier because we do have a taxonomy. And although it brings a lot of interpretation issues, we are expecting social taxonomy in place. It will be soon in place, and it will give us also guidance, and the S aspect will be crucial for construction company because it will touch the upstream and downstream supply chain. So just the comment on this aspect. And now talking about the assets, as Damien mentioned in his presentation, European Commission is aware that 85% of the existing buildings today, they will still exist in 2050 when there is a final goal for the decarbonization. So we do a lot of work on the energy efficiency and net carbon zero, and this is our daily job. If you think about demolishing a building and building a new one, you have to think about the LCA. You have to think about the whole life cost assessment and the whole carbon assessment of the building, and you need to calculate it really well. So of course, to upgrade a building to the net zero, or downgrade to the net zero or nearly zero, can be costly. But we need to always think about the impact on the environment and the climate. Whatever we do, this should be in our DNA on each and every business.
Okay, good. Does anybody? Yes. Oh, you're setting me a task there. I need to. No, that's great. Good to see you, John. This is all part of my fitness, so that's great.
First of all, I wanted to point out to Zoe, don't think we haven't noticed, but you said you hadn't been to Poland, yet you're drinking from a Polish coffee or teacup. So I just wanted to point that out. Cheers to that from Silesia, Bolesławiec. I wanted to ask about, because we've talked about the individual letters, what is the weighting that we have, or a notion of a weighting between the E, S, and G? And further along that point, are we far from an ESG score? We're starting to talk about metrics and rankings, and I think that's the inevitable outcome of all this, isn't it?
Well, I mean, if you look at GRESB, John, which apparently, according to GRESB, I think they monitor about 70% of listed real estate. So that's what they say. I'm not sure whether that's correct. Yeah, I had quizzical eyebrows when one of the guys told me that. It's probably like 30%. But anyway, so their weighting system is 60% is E, 20% S, 20% G. That's GRESB. GRESB. Exactly, mate. It's yet another acronym. But
it's important acronym because
yes,
it's the only one benchmark for ESG for real estate markets.
But interestingly, that they're now still going through a period of looking at their E elements because they haven't really embedded the energy efficiency part or energy usage into it, which I found a bit staggering, but there you go.
But they're developing. As Arcadis Poland, we are an official partner for GRESB, and we are in strict cooperation with them, and they are now added an SFDR model on request of the investors. So you need to be aware that GRESB is a platform built by investors. So they are deciding what kind of information they want to have on the real estate.
If I just may add to that as well, but GRESB is only part of the entire ESG. I think the issue we have at hand is that investors are coming, asking for consistency and trying to drive the market. We at INREV get this request on a daily basis, and the scorecard is to the point, because it's not just about collecting the data, is actually devising something that can be applied in practice and can also be utilized by those funds which are already predominantly ESG compliant and those that are in transitioning, and that needs to be incorporated and built into the mechanics of scoring. So as you progress through transitioning, that can be measured. And we also have the same very question, not just from the equity side of the world on non-listed real estate, but the debt as well. So don't have the answer yet, but working. And just to make it clear that all of the initiatives that INREV are doing are not reinventing the wheel. So when it comes to the scorecard or data collections that we do, we will use GRESB where that's the benchmark. We will use CREM because that they are a benchmark already. We're just bringing it together for investors who are driving this initiative to give that consistency when it comes to reporting.
But maybe, John, if I can comment, if you look at the ESG ratings, if you look into your EcoVadis platform, this is like a very popular rating used by, for example, German banks to judge if they should invest in the merger. So if you go there, you have 3 circles and all of them need to be green. It's not that if you do your environmental part, you're done. No, you have to be good, and S and G. We're talking about environmental part more because it's a revolution. S, it will be a revolution soon, and G is more or less covered also because of the local requirements.
Yeah, but just from the office perspective, I guess that the confusion comes to the last row of this room here, because we have so much building blocks on the local, regional, the international level, and so much interests from stakeholders, which means finance, equity, lending, construction companies, end users, that really nobody has a clue, you know, what it is. And what we see now as flex office operators is that the developers of today try to find an answer by achieving a certificate. But it's like, you know, you say, I have a bad tooth, give me a tablet and I get rid of pain, right? That's not gonna work. So I guess the perception should be, and I would be grateful from the panel to get some practical approach. What is the first step? And I would also like to focus a little bit on a smart approach, which we saw in the previous presentation this morning. We can achieve 50% of the energy reduction with 5% of investment just to change behavior of tenants and end users, right? Why don't we change that one instead of talking of billions of investments on a certificate which is not existing, on an international standard which is not existing, and nobody has a clue where to go? I mean, from the office perspective, for us, it's quite simple. Increasing the utilization of the office place by using space in the cloud and basically using the same space for 500 square meters by double the amount of employees gives you already your 80% improvement in the embedded carbon, which is 10 times the operational carbon anyway, right? So I would really learn a little bit from all the perspective from you guys. What is your advice on the guests and listeners here? What could be the first step beside, of course, collecting data? And I guess that might be the key here, that we are not very well transparent. And if we going as a tenant to our landlords and ask them to break down the maintenance and the reconciliation budget, we basically getting one answer: we can't disclose it because it's subject to GDPR. And that tells you they are not willing to disclose it because it's work, they do not see a sense in it, right? Just as some practical things.
I'll try from a logistics perspective, which is probably the most simple, and then my other panelists here are going to have a harder time. For us, there's three elements. One is solar, which works, which is affordable, that we can roll out. The second is water management. Little bit more problematic, but it's something that is workable and we can do. And the third is insulation, which we were doing already, not frankly measuring what the impact was. We were doing it for different reasons. But they're the three easiest wins that we've been able to ascertain as a logistics developer.
Okay, yeah, it works. Robert Moritz here. We are in a city building. I would like to follow on the question before that. I wonder, we're talking about buildings all the time. Now, I think the very important point is where those buildings are. The same office building in the suburbs where people drive generates 10 times more carbon than the same building downtown. Okay, now social impact. Office building downtown the tower has a very bad impact compared to mixed-use building downtown. So there is, the location is so important. The mass transit solutions are so important. How do we measure this? What impact does it have? And what are the benchmarks? Because I think focusing on the building and high technology, very expensive technology, it's absolutely misleading.
Maybe let me address this. As we are developers, so we don't only rely on existing buildings, but we also create something from the scratch. So it starts with selection of the location, as you rightly mentioned. So one of the examples of our projects that we've done, that was actually greenfield, was a suburban office or actually mixed-use project in Wilanów city, and we saw how this project actually performed during the pandemic. So first we thought we need something that is alternative to Mokotów monofunctional office district. So we said, okay, we need alternative location because Mokotów is already congested. Then we said, okay, what kind of functions do we need? Do we want this to be simply office building with a canteen on the ground floor? No, we want this to be mixed-use project. And the location and the functionality of the project is also linked to what the neighborhood needs, because it was very dynamically growing residential district, which didn't have any public space available for the people to meet, any public parking with access to convenience retail, etc., etc. So there were a lot of factors which we took into account during selection of the right project to build. Design process for the whole building. We designed the project in a way that it is open to public. It serves as a gateway to the residential district. It's at the corner of the residential district, so it's open. People can flow through the properties through our ground floor and actually use all the retail space, food and beverage, with a variety of restaurants on the ground floor and a convenience retail with -1 parking that is available to public, which was not present in the district. And now during the pandemic, it proved that exactly for the reasons you mentioned, people didn't want to actually commute to the center to the work because they were not afraid to be in the office. They were more afraid of commuting in a crowded means of communication. So they were more eager to actually, after a couple of weeks sitting at home, to come to the office that they can actually walk to or take a bike and go to the office and be in a safe environment, because also the way the project is designed is not one core with several elevators and you go to 40th floor with a crowd of people. It's designed in a safe way with 5 different cores and easier to keep safe distance. So this physical occupancy of this building and as a suburban mixed-use project was and is still much higher than in the traditional office districts, and it's much higher than in a CBD. So it starts with a design process and with the selection of location and with the functionality and with the design process for the asset, and then it turns into full occupancy, better rents, and better capital values when you exit. So that's our experience. And now we also are more and more involved into design of the mixed-use complexes like this one, but also in the urban design from the scratch almost. We have a project in Katowice, which is located on a 43 hectares plot, where we actually redesigned the whole. We prepared the whole urban design for a mixed-use project with no cars on the ground, all the cars underground, dominant residential function, but affordable for people. So we're going to make a huge impact on Katowice by doing this. So this is what we understand also. It's not only doing investments in social housing, but you can have an impact investing through creation of the projects that are basically designed with needs of the inhabitants in mind.
Okay, thank you. So for the last just couple of minutes to wrap up, I don't know if this is a silly question because ESG is a topic which is really, we're kind of exploring it. Who do you deal with most? I mean, who's most important for ESG? Is it the national government, or is it local authorities, or are they kind of, business has got to do its own thing? I don't know, Joanna, do you have any observations on that?
Everybody is important. It's the main key to achieve sustainability, because we actually talk about sustainability. And when you ask me where to start with your materiality assessment, check where your company has an impact on which one aspects of the SDGs agenda we do have an impact, put a strategy in place and look for partnerships. But partnership is a key to achieve sustainable future. I don't know if it answers your question.
Well, it's a positive answer. I mean, Zoe, how about you? Do you deal mainly with national government or local authority or in Sydney, or how does that look from your perspective?
Well, we're state government, but we have really strong partnerships with local government, so councils, and also with the federal government. So we're the sort of middle part of that sandwich. But I absolutely agree, it's got to be all parts, because the work that we do, we would not have the political will to put things like mandatory disclosure into the market if the market was not also ready for that and driving ahead of that. So we need private property companies to be really ambitious, because that can be the demonstration that we say, well, let's build a tool, for example, our warehouses and cold store tool that we're launching this year. That's come about because the industry is ready to rate those buildings, and everyone's equally important.
Okay.
I disagree. We all have choices that we make at a personal level. You know, I drive when I should walk and things like that, take too many flights. I think there's a bigger crisis coming for all of us socially, from a business perspective and environmentally. And the only thing that's really going to drive that and make us change is going to be political will. Otherwise, we'll be sat here having all worked hard and, tried to get our organizations to change, and the pace of change will be too slow. I think the only way to speed it up is if it's driven politically.
Okay. Damien, last word from you?
And when it hits you in the pocket.
Okay.
That's when it will really change.
Okay. I think that's bottom line, yeah. Any last comments from our panel? Okay, well, thank you very, very much for sharing your insights. It has been, we're all in it together. I think that's a kind of message. So I hope a panel like this drives things forward in Poland, where it's very much the early stages of ESG, it seems to me anyway. So thanks very much for joining us, Irina, Christopher, Marcin, Zoe, Damien, and Joanna. Zoe, thank you very much for joining us. It must be about 8:30 or 9 where you are. So you're welcome in Poland anytime. And by the way, did you know that mug was a Polish mug in design?
I did. I selected my water mug especially for it.
Okay, very clever. Very, very. We noticed, or John did anyway.